In this week's update, rallies off the bottom of bear markets are the best time to make outstanding returns. Leadership is back with technology. Follow the news and you're dead. Follow your biases and the same. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. The key purpose of this video, which I've been doing for 16, 17 years, starting to lose count now, is to provide an unbiased perspective that's very, very difficult to find in the media, because the media is only ever going to reflect public opinion, and therefore it's almost always going to be wrong at significant turning points, and you've just got to look back through history to know that that's the case. Most people only take a very narrow view of the market. They may use their favourite indicators, or they may let their natural biases take over, how they think the world should be. And making judgments on that basis is generally going to be a significant hindrance. So the important thing is to be able to make judgments with clarity, and that comes from a weight of evidence approach and an open mind to actually acknowledge what you're seeing. And judging by some of the comments that have been associated with this video in recent weeks, there is still some people out there that are definitely not approaching this with an open mind. So if you want to significantly improve your odds of making better decisions, then you need a couple of things. And this is the whole purpose of this video, is to provide a perspective and provide encouragement for everyone out there to open your mind and perhaps acknowledge things that don't necessarily make sense to you. So it's a weight of evidence approach, and that's why just looking at a single, calling something a bear flag and therefore such and such may happen because it looks like a bear flag, or some other indicator that you may be using is just not enough. You need an open mind to acknowledge what you're seeing. You need a breadth of different indicators that that are putting the picture together for you, and then you need the courage and the discipline to act on that. And look, 4 or 5 weeks ago, when the signs first started appearing that that money was starting to rotate back into the more aggressive parts of the market, it was pretty hard to swallow because the news was bad and getting worse by the day. And so the natural conclusion was that, well, how could markets possibly go up in the face of, what we're seeing? But it's what happens at major turning points. The markets turn up when the news is absolutely the worst, and logic would dictate that there's no way that markets are entitled to go up. But that is in fact what happens. And it's not easy to find the courage and the discipline to act on that, but it's absolutely necessary in my view. And certainly members have benefited in recent weeks because we've been in the market, we've been buying, and that's it's worked out quite nicely. So let's have a bit of a status update. Yes, the US economy is contracting. There's no question about that. Yes, the US is probably already in a technical recession. 2 successive quarters would appear now of contraction. So all those things are factual and are acknowledged. The Fed funds rate just got raised another 0.75%, and the Fed said there's more to come, and that's highly likely. We've seen numerous earnings misses from companies, and some big companies like Google, for instance. But prices went up. In most cases, prices went up. Not all, but in most cases they did. And so you got to ask yourself, well, why is that? And the reason is that markets are looking forward. They're looking 6-9 months ahead. They're not looking at today's data. And that's why responding to the news is just such a wasted effort. In fact, it's worse than not looking at the news at all. So they're all the things that are acknowledged, and that's what's happening to the US economy. The US earnings season, it's early days, but it would appear that far too much bad news had been factored into share prices. So that's one explanation. And so, the outlook statement from some of these companies, particularly companies like Apple, have actually been pretty good. And so we're getting a rebound because the market has realised that those share prices had been depressed too far. The other alternative is that the market is looking out 6 to 12 months and expecting the Fed to back off because the US economy is going to continue to contract for a little while. And so the thinking is, well, the Fed will back off from that. And that's why the 10-year yield has dropped as far as it has, because the bond market is saying, well, we just don't see the trajectory of interest rate increases. So that's that's the picture. The overwhelming message I really want to get to everybody is that just have a more broadly based suite of indicators or weight of evidence that you're using, and try and have an open mind that things that you might consider to be completely illogical are actually possible, and just look at where the money flows are going and tell you what the market is or acknowledge what the market is telling you. Okay, so using an index as your primary indicator or using a single chart pattern is just nowhere near enough. It's just never that simple, and you're going to come up with a lot of wrong answers by using that methodology. You've got to be much more broadly based than that. So what traders should be doing is being prepared to adapt to this rapidly changing environment. We're at the start of a reversal after 4 decades of falling interest rates and rising bond prices. We're now in a different environment, and no one really knows how that environment is going to play out. So you've got to be able to adapt readily and change position readily. And you can only do that if you've got an open mind. If you've locked in that a certain thing is going to happen, then you put yourself in a straitjacket, because your mind just won't let you acknowledge what's staring you in the face. So you've got to get control of your natural biases, and we all have them. There's no avoiding it. But the key thing here is acknowledging that you've got them, and be prepared to think in a different way. And I'm absolutely convinced, as I've been saying now for a year or two, that we're going into an environment where the market is not, or all parts of the market is not going to go up together. I think there's going to be very good winners, and there's going to be some very bad losers out of the environment that we're now facing. So I think you've got to be even more selective than what you've been in the past. And if you're either in the market or not in the market because of what the index is doing, then I respectfully suggest that you're on the wrong track, because it's not. You shouldn't be basing it on whether you think the index is going to go up or not. It's what individual sectors or individual industry groups are doing that's important, because that's where the opportunities are going to be. All right, let's look at American stocks. The S&P was up 4.2% for the week. This was the most robust week since the COVID crash. It may not be the biggest percentage rebound, but it's the breadth of the rebound that's been so impressive, as we'll see from the charts. And it came when you least expected it. The news is just, it's as bad now as it's been for the last 2 or 3 months. So a rebound is hardly what was expected, but it is what it is. And that's a huge message there about how you look at market data. If you just look at a couple of isolated points, then you're probably going to come up with the wrong answer. The US dollar index got up to about 109 a couple of weeks ago. We're back down now to just under 106. Still strong, but it certainly came off the boil a bit last week. The 10-year yield absolutely plummeted down to 2.65%, and we'll look at that chart in a minute. The VIX continues to edge down towards 20, so there is certainly an element of fears starting to come out of the market now. And of course, the 10-year, 2-year yield spread is at minus 0.22. It's been there now for about 3 or 4 weeks, and that's generally a pretty reliable indicator of a recession. And the technical data would suggest that the US economy has now just recorded a recession. But look, those sort of indicators, you've got to take them with a bit of a grain of salt. You've just got to look at the broader economic situation. And there's no question that consumers all around the world are getting squeezed with energy prices and food prices and higher interest rates. Naturally, the consumers got to be squeezed. So that part of the market, I think, will struggle. But other parts of the market are rebounding very strongly. So let's jump in and take a look at some charts. Oops, sorry, not getting the right one. I beg your pardon. Right, there we go. Okay, so we'll start with the S&P first of all, and clearly we're now bouncing up through the various levels. We've formed higher highs and higher lows. This would be another milestone up here at 4170, but the strength of the rebound you can see last week, particularly in the last 3 days, as the earnings results and outlooks came in for some of the major tech stocks, was very robust. We're now well and truly above the 50-day moving average. The 20-day, the green line, is about to cross the 50. And none of these things in isolation are really all that important, but it's the whole weight of evidence thing. And so clearly we've got now a very robust short-term uptrend. But if this is all you're looking at, then that's not a lot to hang your hat on, and I wouldn't have a great deal of confidence if I was just looking at the S&P. So we've got to look more broadly at where the money is actually flowing, because a bull market is going to be sustained only if money is flowing into the aggressive sectors. Technology, consumer discretionary, and communication services are the three key aggressive sectors. This is the NASDAQ, which is obviously more aggressively weighted than the S&P, and we're forming higher highs and higher lows, and we've been doing so since the 25th of May, or probably a week later than that. So there's no argument that money is preferentially flowing into the more aggressive sectors of the market. Let's look at consumer discretionary versus consumer staples. And in the 2 weeks since I last looked at this, you can see it's absolutely taken off, particularly last week. Now, admittedly, part of that was a really big jump in the price of Amazon, and to a lesser degree in the price of Tesla, which form about 40% of this index. But quite clearly, we've got robust higher highs and higher lows, and we've now broken out of this downtrending channel. So that was a very significant week in terms of the attitude of the market. Money is very prepared now to flow back into those parts of the market. This is the Russell 1000 growth versus 1000 value, same story. Just a series of higher highs and higher lows now for 2 months. Dow Jones mid-cap stocks versus the S&P. This is just how broad this rally is. So we're seeing mid-caps outperforming as well. So that's impressive. This is the US large cap growth versus large cap value. And again, we're getting a very, very strong rebound. So these are all additional pieces of evidence that you need to form a more accurate decision about what the market's doing. And finally, this is US small cap growth versus small cap value. And they're all saying the same thing, and they've been saying it for 4 or 5 weeks. Yet that's certainly not what you would have got from the media. All right, time to have a quick look now at the 10-year yield. So let's go back and look at the last 1 month in terms of the yield. You can see back here on the 8th of July, we were trading at 3.08%. finished the week at 2.65. So you can see it has come off very sharply. And if we pan back a bit further, let's look at 6 months, then you can see that we've got a series of lower highs and lower lows. So there's no question that the US 10-year Treasury yield is forming lower highs and lower lows. And with the Fed raising interest rates and promising there's more to come, this is not logical. This is not what you'd expect. You would expect that this would be going up to reflect the fact that the fund's cash rate is being raised. But it's not, and the reason it's not is because the market is not looking at what the Fed's doing today, it's looking at what they expect the Fed to do in 6 months' time. And that is a very different story. And the fact that the yield is coming off so sharply is what's really underpinning the flow back into the aggressive sectors. Now, if we look at the 10-year, 2-year spread, so when it goes inverted, so when it drops below this zero line here, it's generally a pretty reliable indicator of a recession. Previously, the last time that happened was in 2019, but it was only for a few days or a week, and then it rebounded very strongly. But this time, it would appear that there's more substance to it. And if we look out over the last 10 years, in fact, we've probably got to go more than that. Yeah, we can see. So when this spread has dropped into the negative, you can see 1980s when we had a very significant recession. Again, at the end of the 1980s, and once again in 2000, and then of course in 2006-07. So that's the picture from the bond market, and it's clearly telling us what we now know, and that is that the US economy is contracting. So there's no argument about that, but the market is responding to it in a very different fashion. So let's look at some other charts that are quite meaningful. So this is Google. They missed on earnings, they missed on revenue. The Fed raised the funds rate by 0.75 percentage point with promises to do more. The US economy is in contraction, but the result was that the price of Google went up. It was down here. The market had priced too much in, and the result and the outlook was actually a little bit better. So markets tend to overshoot on the downside when they're at negative. They overshoot on the upside when everyone gets too bullish, and you just need to be alert to those contrarian opportunities. So that's Google. Let's look at Apple. A much more stunning picture here. The Apple result was obviously very favourably received by the market with a huge gap. And look at the volumes rising throughout the latter part of the week. So no question now we're back above the 200-day moving average for the first time since early May. And so there's been a big reversal in the fortunes of these stocks. This is Microsoft. Again, we've got a breakout on our hands now from a consolidation base, and the volumes very encouraging over the last few days. So this is the reality of the market, and you can stamp your feet and say that it shouldn't be happening, but that's just not the right response. You need to acknowledge what's happening and get on board with it, because there are opportunities to make profit here. This is the US mid caps. So the breadth of this rebound has been very, very impressive. It's not just the Apples and the Microsofts that are dragging the indexes up. This is across the board, and it's into growth in preference to value. Now, a few weeks ago, I put this notation on the Nasdaq chart. I said that if I think we were down here somewhere, we just broken out and formed a new high. But I did say that if you were a more conservative kind of investor, that you might want to wait until we actually break above this high here. So in other words, waiting for more confirmation, more weight of evidence. And that occurred on Friday night. And you can see the volumes in the Nasdaq building throughout the week, and really quite impressive. And this was a week when the market, post options expiry, when there'd been a big run up into options expiry, the week after, normally you would see weakness. And in fact, I think I said a few weeks ago, don't expect anything much from the following week. But in fact, we had a tremendous week. So this is a real vote of confidence in the market. Semiconductors, really important, essential for the next bull market. The bull market's not going to be sustained without semiconductors joining in, and clearly that's happening. And this has been a very sharp rise. Semiconductors as a group are up 10% in the last couple of weeks, which is a pretty big move. Of course, there's a lot of big companies in that industry group. Okay. So let's look at the Australian market now. Our dollar got down to 66 something. We're now back to 69 as the US dollar comes off a little bit. And also commodity prices started turning around again. We'll get to that in a minute. Our index rose 2.3% across the week. Really encouragingly, the emerging companies index was up 11%. So that's small caps in Australia. So we're seeing a broad-based participation there. Just a word of caution though on small caps. There's going to be a lot of small caps that are going to struggle to get funding for what they're doing, and this is a more difficult funding environment. And so, yes, some parts of the small cap market are rebounding, but you've just got to stay with stocks that are not going to be highly dependent on the market funding their growth. And battery materials are going to remain a big winner long term, and look, they're rebounding nicely in the short term as well. So I think that's really a core part that you can build your portfolio around. And also healthcare. We're in the part of the economic cycle and the market cycles where healthcare should do fairly well also. All right, let's just take a quick look then at the Australian market. So there's the ASX 200. Sorry, just get rid of that. So the Australian index has shot up over the last week very nicely, and should get a bit more of a boost on Monday morning as well. Materials starting to rebound quite nicely. If we look at healthcare's had that's healthcare there. The financial sector has also rebounded quite sharply. And this is energy. So energy pretty much paddling sideways, but has certainly done better than US energy. And this is the emerging companies index, XEC. So you can see not only has it been a very, very strong rebound over the last few weeks, but the volumes are up as well. And finally, just the general small cap market in Australia has also done pretty well. So that's the scene in the Australian market. Turning now to precious metals. Gold put on $39 for the week to finish at $17.67. And silver did really well, up 9.4%, and the amount of silver in the London vault is the lowest since 2016. So the demand is outstripping the current supply of silver, and we're starting to see quite a strong reversal in the price of silver. If you look at precious metal stocks, the response was a little better, but it's still not emphatic, so I'm still not jumping on board the precious metals train yet. But I do note that seasonality, this is the time of year if precious metals prices and stocks are going to do well, then this is the time of the year when they'll do it. Now, it's not a prediction that they will, because it's been very disappointing now for some time. But certainly that is in favour, and that seasonality is based on fundamental factors. The fundamental factors, particularly in Asia, around the income cycle and cultural demand influences as well. So there's actually quite a solid basis for precious metals prices to do better, and certainly the demand is there. So let's just take a quick look at those charts. We'll look at silver first of all. It's probably likely that we're seeing some short covering kicking in with silver. This was such a dynamic move from around 18.5, and we closed at nearly 20.5. That's a big move. There was a very large net short position in the futures market in silver. A lot of people have been short for some time, riding it all the way down. But at some point, short positions, the only way that you can realise a profit in a short position is you have to buy your position back. And so you end up from a situation where the majority of people are sellers and there's not many buyers, to all of a sudden we've got mostly buyers and hardly any sellers. And that is what appeared to have happened in the silver market. This was gold on a daily basis, so quite a nice move over the last week. Nice reversal here on the 21st of July, and it flowed through quite nicely. So the underlying metals are actually looking much more encouraging, and this is on the gold on the weekly chart. So we declined to pretty obvious support levels, support that we'd found in March of 2021 and also in August of 2021. But if you look at stocks, and stocks tend to lead the underlying metal, yes, it rebounded over the last couple of days, but stocks are not leading, they're following. And in my experience of tracking the precious metals market closely over nearly 2 decades, normally when stocks aren't leading robustly, these moves don't get terribly well sustained. So the jury's still out for me when it comes to precious metals. So that's the situation there with precious metals. Other commodities, copper had been hit really hard, so had nickel, so had pretty much all commodities, on the expectation that China's demand was going to collapse because of their property bust and that we'd have a global recession, and everyone was ignoring the demand influences from the whole decarbonisation theme. So copper reversed back up to 352. Nickel also kicked up almost back to $10, and this is really just a reflection of the fact that the sell-off went way too far. It just got overdone, and now we're getting a rebound. And I think in the short term, there'll probably still continue to be. I'm not expecting a V-shaped recovery in base metals prices, because I think the short-term outlook is cloudy at best. But the longer-term outlook for copper and nickel and tin and zinc, not to speak about the battery material stocks themselves like lithium and graphite and cobalt, really does look extremely buoyant. Crude, West Texas Intermediate crude finished at 98.3. It was only a few dollar range this week, so it's starting to settle down just under that $100 mark. But stocks were on the rebound. They got energy stocks in America got absolutely smashed in June, but we're now starting to see a solid rebound. Partly because they've just been oversold, and secondly, because of the earnings results that are coming through. So there's the spot copper chart. You can see quite a strong rebound from almost down to 320. And there's the copper inventories. So over the last month, the copper inventories have been pretty much stable. So the price hasn't been falling because inventory levels are building up in the London Metals Exchange warehouse. They've just been going sideways. If we look at nickel, bit of a rebound over the last couple of weeks, not as much as copper, but then again, it hadn't fallen as much as copper either. And if you look at the LME stock levels for nickel, they just continue to fall, and they're getting down now to to quite low levels. So the outlook for the nickel price, and therefore for nickel stocks, is has got to be considered to be fairly positive. So wrapping it all up, final thoughts: you just got to keep investing simple. Too many people want to make it too complex, in my experience. You need clarity over what you want from your portfolio, and you need clarity over the process that you're going to use to get it. And if you don't have those two things, then you probably shouldn't be investing at all. You need an environment to minimize the distractions. It's so easy to get distracted by the media and other things that are going on. So you need to create an environment where you're clear on what you need to do to address that market condition at the time. There are several absolute wealth transforming themes if we look out over the next 5 years. Obviously, decarbonisation is one, several areas of technology, and also in the healthcare space as well. So there are some unbelievably good themes that are going to progress over the next 5 to 10 years that have the capacity to build you a great deal of wealth. But unless you've got the things at the top of this list, then you're probably not going to benefit from it too much. And then finally, you need the confidence to stay the journey. And this is the hard one, to first of all get the confidence that what you're doing is on the right track, and then to stay with it and be resilient when we get periods like we've had so far in 2022. It's it's not the easiest thing in the world to do. Portfolio analyst last week, it was a pretty good session. I covered how I think about the battery materials investment opportunity. And it's easy to get distracted by the short-term crashing that we've had in commodity prices and commodity stocks. And you've just got to think more objectively about where the opportunity is unfolding. We looked at a number of high conviction opportunities that I've got in markets both in Australia and America. And it was a pretty well received session, and members are certainly dialed into the fact that we're now at the start of a pretty good rebound opportunity. So that's it for this week. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.